Welcome back to the Deep Dive, where we take a stack of challenging source material and deliver the absolute core insights you need to be well-informed.
Today, we are really getting into one of the biggest societal fictions we've all sort of inherited.
And that's the idea that your financial freedom, your life's freedom, is tied to a specific date on the calendar, usually, that magic 65th birthday.
Exactly. And that traditional retirement model, it's not just outdated. Our sources show it's actively generating risk for anyone who's still relying on it.
Risk in what way?
Well, you have these economic forecasts and behavioral finance studies, and they all point to this critical disconnect. People are just living so much longer now.
Right, well into their 90s sometimes.
And that means you might need your savings to last 30 or even 40 years, not the 15 or 20 the old model was built for. I mean, it completely changes the math.
It has to.
It does. And then the math gets even more complicated when you throw in these two massive variables. First, steady inflation, which, just relentlessly eats away at your purchasing power over all those decades.
And the second one is healthcare, I'm guessing.
Skyrocketing, unpredictable healthcare costs. So waiting until 65, you're basically relying on institutions and economies that were designed for a totally different world. It's less of a plan and, frankly, more of a financial exposure.
Okay, so let's unpack this. Our mission today is to give you a roadmap. We want to permanently shift your focus away from that passive question, when can I stop working?
To something much more active.
Exactly. To the more empowering question, how can I achieve choice and independence right now? This is all about designing a life on your own terms, completely untethered from the calendar.
So if we agree that 65 is just this arbitrary number, then we have to properly define what freedom even is.
Because it's not just about having a fat bank account.
Not at all. The sources really emphasize that it's not about hoarding money for some distant future. It's a practical, present-day state of control.
So what are the pillars of that? What defines that state of control?
There are three non-negotiables. First is sustainable income. This just means having enough cash flow coming in, whether it's passive or from a passion project, to cover your lifestyle without that psychological stress.
Without the necessity of working.
Exactly. The second is smart investments. Your money has to be actively working for you, compounding, generating returns while you sleep.
And the third?
Genuine lifestyle choices. This is the real prize. It's the flexibility to spend your time and your energy on what actually matters most to you, not what your job dictates.
And what's so interesting is that the sources keep coming back to this idea that freedom is goal-based, not age-based.
Yes. The moment your passive income covers your expenses, you are, by definition, independent. You can still choose to work, maybe you consult for fun or start a nonprofit, but it's a choice. It's never an obligation.
The anecdotes in the research really bring this to life.
They do. I mean, take the example of Mark. He wasn't some high flyer pulling in a massive salary.
Yeah.
He hit independence at 38.
38.
By being absolutely ruthless about his biggest expenses, housing and transportation, he optimized those first, and then just consistently, automatically directed every spare dollar into low-cost index funds.
So the takeaway isn't just save money, it's find the biggest leaks in the boat and plug those first.
That's it, exactly. And then you have Carlos, who was 35. He did it with strategic real estate. But again, not flashy stuff. He was buying small multifamily units in, up-and-coming areas, managing them himself at first to really maximize those early returns.
They both have that same thread, though. Intentional choices, not just trying to earn more.
And zero reliance on a calendar date, which really brings us back to that mindset barrier. So many people delay taking action.
Because we're all taught to think of saving as this vague, far-off task.
Right. And you lose those crucial early years of compounding. I mean, if you miss 5 years of compounding in your 20s, you might have to work an extra decade later just to catch up. The cost of delay is just enormous.
Okay, so if we accept that freedom is a goal, not an age, we need a target. And phase one of this roadmap is about getting absolute clarity. It starts with something called the freedom number.
Clarity is everything. You just can't reach a destination you haven't defined. Now, our audience is probably familiar with calculating net worth, assets minus liabilities.
Right, most of us know the formula, but what's the advanced application here?
The advanced application is to stop looking at it as a static number. You need to focus on the growth rate of your assets relative to the decay rate of your liabilities.
So it's not enough to just be in the positive.
No, you need to see that net worth accelerating upwards over time. If your net worth grows at 5% a year, but inflation is 3%, your real growth is only 2%. Tracking that tells you immediately if your strategy is actually working.
And right alongside net worth is tracking your cash flow, knowing where every dollar is going. But this is more than just basic budgeting, isn't it?
Oh, much more. This moves into behavioral analysis. You don't just categorize expenses like food or entertainment. You categorize them by value alignment,
Value alignment, meaning
meaning which of these expenses actually support the life you want to build and which are just consumption. Identifying that difference is what separates people like Mark and Carlos from everyone else.
okay, this is where it gets really important. Defining the freedom number itself. This is the aha moment where the goal stops being vague and becomes concrete.
This is the ultimate metric. The freedom number is the total amount of money you need in your portfolio to cover your annual living expenses forever just using passive income.
And how do we calculate that?
You need two things. First, your desired annual living expenses. And second, a safe withdrawal rate, or SWR.
Right, the SWR. We always hear about the 4% rule, but that number can feel kind of arbitrary. Where does 4% actually come from?
That's a great question. It's not arbitrary at all. It comes primarily from a landmark piece of research called the Trinity Study.
The Trinity Study.
Yeah, they analyze historical market data portfolios of stocks and bonds over countless rolling 30-year periods. And they found that if you withdrew 4% of your starting portfolio and adjusted that withdrawal for inflation each year, there was a very high probability, over 95%, that the money would last 30 years or more.
So that context is crucial. It's not a guarantee, but it's a historically tested benchmark that already accounts for market ups and downs.
Precisely. So you use that to find your number. If your desired annual expenses are, say, $40,000, you just divide that by 0.04.
And that gives you a freedom number of $1 million.
Exactly. And now you have it, a specific documented number. The entire game shifts from this fuzzy future dream to a defined, achievable financial milestone.
So once you have that clear number, phase two is all about designing the action plan. You have to break that, million-dollar goal into manageable stages so it doesn't feel so overwhelming. Okay, so we segment the journey. Let's start with short term, the first 0 to 2 years. What's the absolute highest priority?
Resilience and momentum. The very first thing you have to do is build your emergency fund. That's your 3 to 6 months of living expenses. That's the firewall that protects your investments later.
So you don't have to sell stocks in a down market to fix your car.
Exactly. Then you eliminate any high-interest toxic debt, credit cards, things like that, and you start automating your very first, even if they're small, investments.
All right, moving into the midterm, 2 to 5 years out, this feels like where the acceleration really happens.
This is where you shift into high gear. You pay off any remaining medium interest debt. You start to seriously scale your side hustles or other active income streams, and you diversify your investments. Maybe you move beyond just index funds into real estate or other assets.
And I imagine this is where you really focus on maxing out tax-advantaged accounts.
Absolutely. And then long-term, 5+ years, that's the final push to hit that freedom number. But like we said before, this whole plan just falls apart if your lifestyle doesn't support it.
Which brings us to the silent wealth killer. Lifestyle inflation.
It's the most insidious trap there is.
And it's this thing where our spending just seems to rise in perfect lockstep with our income. Why is it so powerful?
It's rooted in something called hedonic adaptation. It's just a fancy term for a basic human tendency to get used to good things really quickly.
That $10,000 raise feels amazing for a month.
And then it just becomes your new normal. And if you spend most of it on a bigger apartment or a new car, you've actually just increased your financial burden. You haven't moved any closer to freedom.
So you're confusing material comfort with genuine independence. Instead of using that money to buy your future time, you use it to buy things that just increase your monthly expenses.
Precisely. The key is to actively fight that adaptation. The sources suggest a rule. When your income goes up, immediately direct 50% or more of that new money straight into your investments before you even feel it.
And that's where intentional living, or minimalism, comes in. It's not about depriving yourself.
Not at all. It's about freeing up capital, reducing stress, and just accelerating your path to that freedom number.
Let's move to phase 3, strategic investing in income. We talked about the huge cost of delay. Let's just underline the power of compounding one more time.
Compounding is the engine. It's the whole engine that drives this entire plan. It's your returns generating their own returns over time. It's exponential. If you wait, you don't just lose the money you could have invested, you lose the time that money could have been working for you.
And to put a number on that urgency, if you invest $10,000 today at a 7% return, in 20 years it's worth almost $39,000.
Right.
But if you wait just 10 years to start, at the end of its 10-year period, it's only worth about $19,700. That's a massive difference from just a decade of inaction.
It's huge. And this reliance on compounding also shows why, depending on a single paycheck, is so risky. Job security is largely an illusion. You need multiple streams of income.
What's the ideal mix there? What should we be looking for?
You want a blend of active and passive streams. Active streams, like freelancing or high-value consulting, let you inject large chunks of cash into your investments early on.
To get the snowball rolling faster.
Exactly. But the passive sources are the long-term engine. Things like real estate investment trusts, dividend-paying stocks, index funds. Passive income, what buys back your time. That's the ultimate prize.
Now, when we talk about maximizing investment returns, we have to talk about tax efficiency. And for this audience, just listing 401k isn't enough. How do you strategically house these accounts for early freedom?
This is such a critical point, especially if you want to be independent before, age 59 and a half. These accounts let your money grow without being taxed or with taxes deferred, so it works much harder.
So what's the strategy?
The key strategy revolves around balancing your Roth contributions versus your traditional contributions.
Okay, explain that balance for us.
Sure. Traditional contributions, like a 401k, are tax-deductible now, so they lower your current tax bill. But you pay income tax when you withdraw the money. Roth contributions are the opposite. You use after-tax money, but all the growth and withdrawals are tax-free forever.
So if your goal is freedom before 60, how do you get around the early withdrawal penalties?
This is the advanced tool. You use what's called a Roth conversion ladder.
The ladder.
Yeah. Early in your career, you contribute heavily to traditional pre-tax accounts to get that tax break. Then, once you stop working, you start converting chunks of that traditional money into a Roth IRA each year. After a 5-year waiting period for each conversion, that money becomes yours to withdraw, completely free of penalties, decades before the official retirement age.
That's the key. That strategic interplay is the tool for unlocking those funds early.
It is. It's how you build a bridge to access your own money on your own timeline. We have to acknowledge, though, that this path it's not easy, it's challenging, and it's never a straight line. And the biggest barriers are rarely the stock market. They're almost always psychological.
You're talking about the psychological traps of delay, the fear of making a mistake, that analysis paralysis. It's huge.
It is. Or just a feeling of being overwhelmed by all of it. But the most universal trap is instant gratification, choosing a small reward today over the life-changing benefit of freedom tomorrow.
It's a battle between your present self and your future self.
It really is. And to beat that analysis paralysis, the sources all point to one powerful, simple solution: automation. Automate everything. Your savings, your investments. You make the right decision one time, and then you don't have to rely on willpower every single day.
And when obstacles do hit, because they will, a job loss, a big unexpected expense, how do you handle that setback without completely derailing all your progress?
You fall back on your financial defenses. We already talked about the emergency fund. That's your buffer. But if you take on new debt, you have to be strategic. Prioritize it with the debt avalanche method.
The avalanche, that's where you attack the highest interest rate debt first, right? Regardless of the balance.
Exactly. Because mathematically, that's the debt that is actively working against you the most. But emotionally, just maintaining momentum for a 5 or 10-year goal can be exhausting.
So how do you keep that fire lit?
You have to focus on what you can control. And you have to celebrate the wins. Don't obsess over what the market did today. Obsess over your savings rate this month or your net worth increase this quarter.
By breaking that huge freedom number down into smaller milestones, like hitting your first $100,000 invested.
Yes. You build confidence. You create your own psychological momentum. At the end of the day, resilience, not perfection, is the only strategy that actually works long term.
That was an incredible deep dive, a true roadmap for designing financial freedom outside the antiquated idea of waiting until you're 65. It really is a journey defined by clarity and action.
You now have the key tools. You know how to calculate your strategic net worth growth, how to define your target with the freedom number, and how to leverage the incredible power of compounding by just starting today.
And you know you have to play defense by fighting lifestyle inflation and aligning your spending with your actual goals. Then you accelerate the timeline by building multiple income streams and strategically using tools like the Roth conversion ladder.
But the whole strategy, all of it, demands that you take action today. Every single day you wait is a day of lost compounding, And more importantly, it's a day you delay taking control over your own time and your own life.
So we'll leave you with this final thought. If financial freedom is really about achieving choice and independence and not just waiting for age 65, how does visualizing the lifestyle you actually want, rather than just the final investment figure, change the priority you give to automating your very next contribution? Think about what specific action you can automate right now to move toward that chosen life.